Phase 1. What are the drivers? So in this phase, we're going to identify current change drivers and create at the management level a desire to change. So a change driver could be an internal or external event, right? It could be, for example, a new trend, industry new trend, a new technology. And also at this stage, we're going to list the risk associated, okay, with the change itself, should be described. Then we move to phase 2. Where are we now? Right? In this phase, we can align IT-related objectives with enterprise strategies and risk. And we're going to prioritize the most important enterprise goals, alignment goals, and processes. Right? We have seen examples how to identify the processes in COBIC 2019. Now move to phase 3. Where do we want to be? So we're going to set a target for improvement, and also identify potential solutions. That is phase 2. What needs to be done? Basically, we're going to describe how to plan feasible and practical solutions. Okay, then move to phase 5. How do we get there? We need a plan. Phase 5 provides for implementing the proposed solutions through day-to-day practices and establishing measures and monitoring systems to ensure the business alignment is achieved. And performance can be measured. Okay, so we need an executive plan at this stage. Okay, then we're going to implement a plan. Then move to phase 6. We're going to check, right? Did we get there? Then move to phase 7. How do we keep the momentum going? Well, basically, we're going to review the overall success of the initiative, right? Identify future problems, then keep going. Alright, so all these are a general introduction of the COBIC 2019. Okay, so for more information about COBIC 2019, we also have additional reading if you're interested in the Blackboard folder. Additional readings, okay? I uploaded the COBIC 2019 materials. If you're interested, you can read those. All right. So test the knowledge, and we move to the next topic, the COSO. Right. The COSO's internal control framework, also known as IC framework. COSO stands for the Committee of Sponsoring Organizations of the Threadway Commissions on Fraudulent Financial Reporting. Okay, this is their website, coso.org. And COSO is an organization sponsored by the following organizations: American Accounting Association, right, ACCT, and many others. There are a lot of publications. The first of which was Internal Controls, okay, Integrated Framework, or the IC framework. This defines internal controls and provides guidance for evaluating and enhancing internal control systems. Alright, so we have seen the COSO IC framework basically has the 5 parts control environment, risk assessment, control activities, information and communication, and monitoring. The 5 parts form an integrated whole. Okay? So this goes integrated framework. And currently we have 17 principles, okay, within this framework. Next, the COSO ERM, okay, which stands for Enterprise Risk Management Integrated Framework. This is a COSO expanded. Basically, it expands on the elements of the IC framework in the previous slides. Okay, the basic principles are expanded. Behind these enterprise risk management are companies are formed to create value for their owners. Companies' management must decide how much uncertainty it will accept as it creates values. And then uncertainty results in risk, and uncertainty can also result in opportunities. And the COSO ERM helps management to manage uncertainties and its associated risks and opportunities so they can build and preserve value. These are the basic principles of ERM, COSO. The last update was 2017, okay, and this COSO ERM is retitled as Enterprise Risk Management Integrated with Strategy and Performance. Okay, this is a new title now. But basically they're talking about the same thing, COSO ERM. Okay, let's talk about the components of the COSO ERM 2017. Right, first, it's governance and culture. Basically, the governance sets the organization's tone, right? And the culture pertains to ethical values, desired behaviors, and understanding of risk in the entity. Second is strategy and objective setting. Then we have the performance. And risk needs to be identified, assessed, and prioritized. The context of risk appetite. Then the organization then selects risk responses and takes a portfolio view of the amount of risk it has assumed. And we have the review and revision, right? Then finally, information, communication, and reporting. Right, these are the 5 components in the most recent COSO ERM framework. And also, this 2017 framework has expanded the control principles. Okay, so for those 5 components, they have several principles for each component. In total, we have 20 control principles. For example, for governance and culture, right, we have exercise board risk oversight, right, as one of the principles. They also establish operating structures is a second principle in this component. All right, so you can read these components the principles. So the major difference between COSO and COSO ERM is that COSO ERM's focus is on risk-based approach. Okay, we see more risk ingredients in this framework, and the components are expanded for this approach. Otherwise, they are conceptually they are very similar. Okay. And also we have some updates about the COSO ERM. For example, 2018, we have this guidance on applying ERM to environmental, social, and governance-related risk. Then 2019, there's guidance on managing cyber risk in a digital age. Then the 2020 have the guidance on compliance risk management, applying the COSO ERM framework. Okay, these are the most recent updates about the COSO ERM. Okay, some test knowledge. All right, so now let's move back to the COSO, okay, IC framework and talk about those topics. Right, basically these also address the principles and components in COSO ERM. Right, they're related. Control environment. So the control environment or the company's culture influences how organizations establish strategies and objectives. Okay, so this could be the most important component of ERM. It consists of the following things: control environment. For example, the management philosophies, right, operating styles or risk appetite, and many other things. Okay. Assessing the control environment involves observance of the organization's behavior, of management actions, and evaluate of policies and procedures. For example, if their written code of conduct that explicitly describes honest and dishonest behaviors, does the company exhibit good hiring practices? Okay, to be evaluating qualified applicants and conducting thorough background checks. Okay. So for all these things, we can assess the internal controlling, the control environment of the company. We have the risk assessment. Risk is assessed from two perspectives. Its likelihood, which is the probability that the event will occur, and its impact, which is the potential loss. So we're going to estimate from these two perspectives. So my expected loss is a likelihood multiplied by the impact, right? And there are two types of risks. One is inherent risk. These are the risks that exists before plans are made to control it. Okay. Then we also have residual risk, which is risk that is left over after you control it. The ERM model indicates 4 ways to respond to risks. First, reduce means we're going to implement effective internal control to reduce the likelihood and impact of risk. Second, accept. We do nothing. Accept the likelihood and the impact of risk. Right? For example, you can calculate the expected loss. Right? If you accept the loss, okay, we do nothing. And we can share the risk. Okay? We can share some of the risk or transfer it to someone else. For example, we can buy insurance, right? Can outsource some activities, or you can sign a hedging contract. And the fourth one is avoid risk. Okay, we can walk away. We do not engage in the activities. Okay, so we can avoid risk. And when we respond to risk, we also need to consider the cost and benefit. Okay, we're gonna respond to risk through the most cost benefit through a cost benefit trade-off, basically, right? If it's too costly to adopt a certain response, then we have to pick the alternative response, right? Right, for example, a system is deemed to be 90% reliable, okay, so 10% unreliable. A major threat has been identified with an impact of 3 million. Two control procedures exist to deal with this threat. Okay, we have control A costs $100,000 and reduces the likelihood to 6%. Control B costs $140, reduces likelihood to 4%. Right, so control B is stronger effect but more costly. Implementation of both controls would cost $220 and reduce the likelihood to 2%. Okay, then what should we do? What should we do? Then we're going to trade off the cost and the benefit to see what is the net benefit, right, those controls can bring to us. The net benefit of A can be calculated as, because it reduces the risk from 10% to 6%. Okay, so we're going to save 4% of the loss, potential loss. The 4% multiplied by the potential loss, this is the benefit we're going to get from implementing A, less the cost of A. Right? So if we do the calculation, we're going to get, it's about $20,000, right? $20,000 benefit. If we look at control B, if you do the calculation, right, the benefit will be $40,000. And then control A and B together, again the benefit $20,000. Alright, so based on these benefit control considerations, probably control B is going to bring us the largest benefit in this case. Right, you can test your knowledge right here. Also, let's talk about control activities. Policies, procedures, and rules that provides reasonable assurance that control objectives are met and risk responses are carried out. So, what are these control procedures? So we have the proper authorization of transactions and activities. So management establishes policies for employees to follow, okay, and then empower employees to perform accordingly. And this empowerment is called authorization. Okay, authorization is an important part of the organization's control procedure. Examples of authorization: signature or name initials. We have general authorization and specific authorization. Right, for certain transactions, employee need to get specific authorization from the management. Okay, we call these specific authorizations. But on routine work, right? Employees are authorized to do the routine work without further authorization. That is known as the general authorization. Next is segregation of duties. Now basically, we're going to segregate, right, the accounting duties, the accounting of the authorization, recording, and custody. Can segregate these three duties. Okay, we're going to talk about that. Also, in the system duties need to be also segregated. For example, in the system, the authorization, data entries, programming, operations, data storage, uses, management, these duties will be also segregated. And here we're going to take a look at accounting, how we're going to segregate, right, these duties. Right, good internal controls require we cannot put a single employee to handle more than one of the following three functions. Right? Custodial functions, for example, the employee is going to handle cash, why? Manage inventories, right? Write checks or receive checks. These we call them custodian function. Okay, will be separated from an employee that records transactions. For example, prepare source document, right? Doing journal entries, ledgers, right? Prepare reconciliations. Right, one typical example is the person who handle cash cannot also do the reconciliation of bank statement. Otherwise, it's easier for the employees to steal the money and hide the wrongdoing, right, in reconciliation. And also, the custody functions and the recording functions, they all need to be separate from authorization functions. So the manager who has authorization roles cannot handle cash, right? Also cannot, will not, right, prepare all those recording stuff like journal entries. Right, for example, if the manager is doing both authorization function and the recording function, the manager can prove fictitious transactions actually to his or her own account and prepare a purchase order using his or her recording functions. Okay, so by separating these duties, we can prevent all those risks, basically. All right, and you can take a look at these two examples to see what's wrong, okay, with their internal control. Basically, some roles are not segregated. So we continue with the control activities. We have the change management controls. Basically, we want to make sure that the change do not negatively affect the system's reliability, security, right? And also design and use of documents and records. We need to have a proper design use of electronic papers document. And then we have the safeguarding assets, records, and data. We need to create and enforce appropriate policies and procedures, right, to maintain accurate records of all assets, restrict access to assets, and protect records and documents. And finally talk about independent checks on performance. Right? We need to have top-level reviews, which is management at all levels should monitor company results and periodically compare actual results performance to planned performance or prior period performance and performance from the competitors. We also have the analytical reviews. Okay? Analytical reviews is examination of the relationship between different sets of data. Data is going to tell us something. If we see abnormal data, something might be wrong. For example, there is certain relationship between sales and cost of goods sold, or sales and inventories, or sales and shipping cost. If we see abnormal relationship between those data, something might be wrong. This is an analytical review. We also have the reconciliation of two independently maintained sets of controls. Right? For example, bank reconciliation is one of the control. Right? And also we can compare subsidiary ledger total with general ledger total. Okay, this is also kind of a reconciliation. Okay, we can comparison of actual quantities with recorded amount. Right, this is a very basic, just like inventory physical count, right? And double entry accounting is also a good control. And finally, the independent review. Okay, after one person processes a transaction, a second person sometimes reviews the work of the first. Right? And information and communications. So the EIS, right, have five primary objectives in terms of information communications. Basically, we're going to identify and record all valid transactions, right? Properly classify transactions, record transactions at their proper monetary values, record transactions in the proper accounting period, and properly present transactions and related disclosures in the financial statement. And the communications must occur internally and externally. And all personnel must understand, right, their responsibility. Right? Monitoring. The internal control system must be continuously monitored, evaluated, and modified as needed. So what are these monitoring activities? We can use responsibility accounting systems like budgets, right? Monitor system activities. Going to track purchase of software and mobile devices. Conduct periodic audit internally and externally, and employ computer security officers, engage in forensic specialists, right? Install softwares, implement fraud hotlines. All these are monitoring activities. Alright, so we have a case studies. So I'm going to identify the IC weakness and suggest ways to correct them. Right? So you can go through these case studies. And we have some suggested answers to see whether you can get some of these by your own. Okay. All right. So this is a brief review of lecture 4. Okay. So basically, you need to go through the notes and also read a textbook. Okay.